Building a property portfolio in your 20s is a great way to building wealth for your future. Real estate investing, even on a very small scale, remains a tried and true means of building an individual's cash flow and wealth. This is a quote by Robert Kiyosaki, who is an entrepreneur and an investor. So here are some tips to help you getting started so that you can build your millionaire's property portfolio in your 20s. 1. The early bird catches the worm. Building a property portfolio requires some capital, so it's very important that you get started on this process quite early on in your life. For a $400,000 property, it is estimated that you need about 16% of the value of that property, i.e. $64,000, saved up before you can get started. This is to cover things like your 10% deposit, your LMI, your stamp duty, conveyancer costs, pest and build costs, and any other admin related costs as well. It's just a ballpark figure. What you need to do is create a budget and set aside some money each week in your savings to work towards building up that savings pool. You could consider opening up a high yield savings account, or if your parents have already purchased property in the past and they've got some equity built up, you can extract that equity and they can gift that to you as well to get you started. Alternatively, you could also get a guarantor's loan. I started my property journey at the age of 24, so a little bit later than usual. However, in the last 3 years or 4 years, I have been able to build a property portfolio of about $1.5 million. So there's a sign you can definitely go out and do it, and it's achievable as well. 2. Educate yourself. Before investing in real estate, it's very important to understand the market and understanding the investment strategies that are out there and what's going to work for you. It's very important to read books, follow people on Instagram who talk about finance, attend seminars, and talk to people who have actively gone out and purchased investment properties or owner-occupied properties as well. According to CoreLogic, Australian property prices have grown at an average rate of about 6.8% over the last 25 years. Whilst past performance is not an indicator of future performance, we can definitely see that there is an upward trend of property prices increasing in the long term. This also depends on where you buy and what time of the market you purchase as well. So doing your research definitely matters. I managed to buy an investment property in 2020 for $237,000, and it has actually appreciated by 50% in just 2 years. This is where I say that getting a buyer's agent may actually be beneficial so that they can find the properties that actually have the capital growth or are cash flow positive if that's what you're after. 3. Start small. It's important to start small when it comes to property investing. Consider buying a smaller rental property, or you could actually flip properties, or you could actually look into investing regionally, which is what I've personally done. You don't need as much capital as you would if you were to buy your own house, or if you're looking at buying a $1 million investment property. As you gain experience and the capital grows within your property and it appreciates, you can look at expanding your property portfolio over the years. Real estate can generate consistent cash flow through the rental income that you receive. So this is where you've taken out a loan for your investment property. However, you've got tenants in your property that are paying down your mortgage for you. According to Domain, the average rental yield in 2022 was 3.7%. Was 3.7% for houses, and it was 4.4% for apartments. This potentially means that you can earn about 4% of the property's value in just rental income in that year. These stats are quite generalized and take into account the whole of Australia and different locations. However, if you do buy an investment property regionally, you can see your first year ROI, which is your return on investment, be around 30 to 40%. 4. Leverage other people's money. You don't necessarily need to save up each time to purchase another investment property. You can consider using a mortgage each time to finance your future purchases. Let me explain. So when I bought my first investment property in 2020, 6 months later, it had appreciated in value. I was able to extract some of that equity. So that is your property value minus the loan amount, and whatever is left over is considered as equity. So you're able to take that equity out given your serviceability allows for it. So this means that you can actually finance the loan by increasing the loan back up, because you're going to take out that equity. So the loan is going to go back up, and then you can use that money to purchase for your next investment property without having to put money out of your pocket for the deposit and all the other costs that I've mentioned. This is where you rinse and repeat this cycle, given your income is consistently increasing over time and your properties are appreciating in value. You're able to utilize the bank service offerings, i.e. the loan, and keep increasing your loan so you can increase your property portfolio over time. Real estate investors are also able to take advantage of some tax benefits when you purchase property, such as negative gearing, and capital gain tax discounts. According to the Australian Tax Office, real estate investors are able to deduct on the cost of owning a property and the maintenance for a property as well. So this could include getting deductions on your interest that you pay, any repair or maintenance work, and the property management fees. So this could reduce your taxable income over the year. Investors are also able to receive a 50% discount on capital gains tax if you hold the property for more than 12 months. 5. Be patient. Building a property portfolio takes time and patience. It's important to have a long-term perspective and not get discouraged by any slow progress or any setbacks. You may need to hold onto your property for about 2 to 3 years before you start experiencing some significant capital growth. Australia has a booming population and a shortage in supply for properties, which we can see are driving up the costs of property purchases and also increasing rental income. According to the Australian Bureau of Statistics, they estimate that Australia's population will grow to 39 million by 2061. This could mean that there could be increasing demand over the coming decades, again raising the cost of property. 6. Cash flow versus capital growth. When purchasing your investment property, you need to decide whether you want your property to be cash flow positive or you want it to have capital growth. Having a property that is cash flow positive means that your income is greater than the expenses. So this includes the mortgage payments, the tax payments, and the maintenance costs. It's important to source properties that are located in desirable locations and have a low vacancy rate and also a strong rental demand in that area. Purchasing capital growth properties are a great way to increase your investment portfolio over time as you are able to extract that equity and purchase multiple properties. 7. Diversify. We all know how important it is to diversify your investment portfolio, and the same goes with property. Therefore, it's very important to consider investing in properties in different locations so that you can minimize your risk. According to the Reserve Bank of Australia, Australian residential property returns have had a low correlation in terms of volatility as compared to other asset classes like stocks and bonds. Therefore, adding property to your investment portfolio could significantly reduce your risk. Therefore, building a property portfolio in your early 20s is a great way to start building wealth, but it requires discipline, it requires patience, and a long-term approach. By following these steps and speaking to the right people, you're also able to pave a path for yourself and ensure that you achieve financial success over time. And that is it from me, and I'll catch you guys in my next video. Bye guys.